How to save money on taxes. In this video, we will do a deep dive into practical ways to save money on taxes. Saving money on taxes can seem complicated, but it doesn't have to be. With some planning, you can reduce your tax bill and keep more of your money. In this video, I'll discuss everything from deductions to credits. We'll cover strategies that will work for you if you are an employee or self-employed. And I will provide a step-by-step guide to save money on taxes. Hi, I'm André, and I am a certified financial planner that collaborates with tax-conscious people like you to save money on their taxes. So first, let's understand the basics. The more money you make, the more taxes you pay, potentially. The government uses this money for services like roads, schools, and healthcare, amongst other things. How are taxes calculated? Your taxes are based on your taxable income, which is your total income minus any deductions or exemptions. Once your taxable income is determined, it falls into tax brackets, which are like tiers. The higher your taxable income, the higher the tax rate in each tax bracket. So now, for example, if your taxable income is between $96,951 and $206,700 and you're married filing jointly, your tax rate is 22% in 2025. One of the key ways to save on taxes is through deductions. Tax deductions lower your taxable income, which in return reduces the amount of taxes you pay. There are two types of deductions, the standard deduction and itemized deduction. The standard deduction is a set amount everyone gets to subtract from their income. For 2025, it's $15,750 for single filers and $31,500 for married couples filing jointly. If you're 65 or older or blind, you could get an additional deduction amount of $1,600. Itemized deductions are particular expenses you can list, like medical bills or mortgage interest, instead of taking the standard deduction. Common deductions include mortgage interest, state and local income taxes up to $40,000, medical expenses, charitable donations, and business expenses for the self-employed. Next, let's talk about tax credits. Tax credits directly reduce the amount of tax you owe and can even create a tax refund. Here are a few common tax credits. The child tax credit. If you have children under 17, you may qualify for a credit up to $2,200 per child. Earned income tax credit. This credit helps low to moderate income workers. The amount you receive depends on your income and the number of children you have. There are also education credits like the American Opportunity Credit and Lifetime Learning Credit, energy efficient home improvement credits, and energy efficient vehicle tax credits. Contributing to retirement accounts like a 401k or IRA can also save you a lot on taxes. These accounts offer tax benefits that either reduce your taxable income now or allow investments to grow tax-free. For 2025, the 401k contribution limit is $23,500 or $31,000 if you're 50 or over. For the IRAs, you contribute up to $7,000 or $8,000 if you're 50 and over to a traditional IRA, which also can reduce your taxable income if you meet the requirements, like you do not actively participate in a workplace retirement plan, or your income is below the threshold. Roth IRAs are also a great option for future tax-free withdrawals. Understanding capital gains and losses is crucial. Longer capital gains from investments held for more than a year are taxed at a lower rate. And in this video, I covered an actionable tax strategy around capital gains and to maximize after-tax returns. So check that video out. Also, you can use strategies like holding investments for over a year to benefit from lower long-term capital gains rates and tax loss harvesting to offset gains from other investments. So how does this work in an actual situation? Let's look at an example. You have an investment account that has some investments that have gains and losses. Tax loss harvesting allows you to sell some of the investments with losses to offset the sale of the investments with gains. This is beneficial in two ways. You can sell the investments that are at a loss and may no longer align with your investment objective. And you can sell some of the investments that have gained to reallocate back to your target investment allocation. More information about capital gains is available in this video, linked in the description below. If you're self-employed or run a small business, many expenses can be deducted, reducing your taxable income. Common deductible business expenses include home, office deduction, travel, and vehicle expenses, and equipment and supplies. Contributing to a SEP IRA or solo 401k can also reduce your taxable income while saving for retirement. These plans have higher contribution limits compared to traditional IRAs. Your filing status affects how much tax you owe. Choose the one that best fits your situation: single, married filing jointly, or head of household. Claiming dependents can also qualify you for other credits and deductions. A professional can help you find deductions and credits you might miss on your own. They can also ensure you stay compliant with tax laws and avoid costly mistakes. For simple returns, tax software may be enough, but for more complex situations, hiring a tax professional may be worth it. Effective tax planning isn't just for tax season. Make adjustments throughout the year, like adjusting your withholdings if you had significant life changes, and time your deductions and contributions to maximize their benefit. That medical procedure that you have been putting off for a while may benefit you from a tax standpoint. If you have multiple qualified medical expenses that will allow you to take an above the line deduction for those expenses that are more than 7.5% of your adjusted gross income. And when I say above the line deduction, I'm referring to a deduction that is taken before you apply any credits or itemized or standard deductions, meaning your starting taxable income is actually going to be lower. By taking advantage of deductions, credits, and tax advantage accounts, you can reduce your tax bill and keep more of your money. Remember, a little planning goes a long way. And if your situation is complex, working with a tax professional can make all the difference. Stay informed, plan ahead, and you will be on your way to keeping more money in your pocket at tax time. Now let's go through the step-by-step guide to save money on taxes. Step 1. Start with your income. Gather wages, rental income, investment gains, and any other earnings. Then subtract deductions like contributions to an IRA if you qualify, student loan interest, or money contributed to a health savings account. What's left? That's your taxable income. Pro tip: keep records throughout the year. It would help make this step less painful during tax time. Now, step number 2. Choose the right filing status. Your filing status matters. Single if you're not married. Married filing jointly if you want the lowest taxes as a couple. Head of household if you're single with dependents. Choose the one you qualify within that saves you the most. Step number 3. Standard versus itemized deductions. You have two choices: standard or itemized. For 2025, the standard deduction is $15,750 for a single and $31,500 for couples filing jointly. If your mortgage interest, medical bills, taxes, and donations add up to more itemized, keep receipts, especially for charity and medical expenses. Step number 4. Claim tax credits. Lower your tax bill dollar for dollar. Child tax credit, $2,000 per child under 17 years of age. Earned income tax credit for low to moderate income. And then education credits like the American Opportunity or Lifetime Learning credits. Make sure you receive your 1098-T tuition statement for education purposes when you file your taxes. Now, step number 5, maximize retirement contributions. Retirement accounts cut your tax bill today. In 2025, you can put $23,500 into your 401k, $31,000 if you're over 50. For IRAs, $7,000 or $8,000 if you're over 50. Prefer a tax-free retirement? Consider a Roth IRA. Set up automatic contributions to save without thinking about it. Step number 6, manage investments and capital gains. Hold investments for over a year to pay lower capital gains taxes, sometimes as low as 0%. Use tax loss harvesting, sell losses to offset winners, and keep an eye on capital gains. Distribution from mutual funds. Don't let this surprise you. And then step number 7, deduct business expenses if you're self-employed. So business owners, this is big. And don't forget it, deduct your home office expense, travel, and meals if they're for business. And don't forget retirement plans like SEP IRAs or solo 401ks. They offer high contribution limits and cut your taxable income. Now, step number 8, use tools or hire someone to help. For simple returns, software like TurboTax or H&R Block is enough. But if you run a business or have multiple income streams, a tax pro can save you money and headaches. They'll also help you plan for next year. And then step number 9, adjust withholdings and plan ahead. Life changes, new job, marriage, or kids. Update your W-4 so you don't owe next April. Plan ahead, track expenses, add to retirement accounts, and set yourself up for tax savings all year long. Now that you are saving money on taxes, find out what to do to avoid mistakes when saving money in this video. See you in the next video.